Why is the Lenskart IPO valued at 230 times PE even when it is mostly offer for sale? Offer for sale, for those of you who don't know, is the portion of the IPO that goes to the early investors to cash out. Now, a lot of early investors invest in the private stages of the company and they expect to make a return when the company goes for an IPO. The offer for sale money is not available for the company to invest in its business. This is different from the primary fundraise, which is actually the money that goes to the company. So the question is, why are these overpriced IPOs coming to market and how come promoters, early investors and IPO investment bankers are so sure of sailing through? The reason is that there has been a great inversion in the Indian markets. Normally, companies in need of funds come to the markets and investors, both retail and institutionals, allocate scarce funds by picking and choosing the right IPOs out of the many that are available. Earlier, it was not uncommon for companies to file their DRHP with SEBI but not go through with the IPO since there was not enough demand from investors. But now a little detour. Let me explain how the IPO process practically works. I have been an investment banker for more than a decade, and in my time, I have brought several well known companies to market via IPOs. Here's how the IPO process really unfolds. It starts with internal discussion. The management decides to go public and hires a lead banker. Then comes the due diligence and the drafting of the DRHP, the draft red herring prospectus, which is reviewed by SEBI. If you want, you can go to the SEBI website and review the recent red herring prospectuses of multiple different companies which have gone for IPOs. Lawyers, bankers, and auditors spend weeks combing through every number, every risk factor, and every business detail. Once that is cleared, we move to valuation. Discussions around what kind of valuation the company will command, how much fund will be raised, how much will be primary, how much will be secondary, and so on. And finally, there are the all important road shows. Road shows are where the company's top management meets institutional investors like mutual funds, insurance companies, foreign portfolio managers, and presents their case. These investors ask tough questions about the margins, growth, and competitive advantages. By the time of the roadshows are over, it is very clear to the management whether or not there is appetite for investors for buying their shares. However, today in the Indian market, there is more capital than ever. IPOs are not a need for companies. Rather, they are being manufactured by the demands of capital, which has nowhere else to go. Indian retailers are constrained by law to participate in the Indian market by RBI restrictions. You know that there are remittance scheme limitations placed upon Indian investors by RBIs to make sure that there is no large outflow of dollars. And global funds are more than happy to get their exit from these retailers. Look at some names: Paytm, Nykaa, Swiggy, etc. Most of these saw massive retail participation followed by underperformance. Now, we cannot blame the companies for seeking a high valuation. Who does not like money? And it is a free market. So, when Lenskart comes and demands 230 times PE or Grow demands over $7 billion in valuation, it is the investor who needs to answer certain questions. Let's ask, what does a valuation of 230 times PE means? It means that you are happy to buy a business that generates 1 rupee for you if you pay 230 rupees first to get that 1 rupee of profit, which means that it will take 230 years to earn back your initial investment at this rate. Does that look like a sound investment to you? Now you might be thinking, who cares? I will just get my one lot and sell the IPO pop of 20% or 20%. If that is you, you should rather be in a casino than in your brokerage account. However, if you're someone who understands why you are investing and want to get sharper, join my NISM 15th course. This is designed for people who want to become SEBI-registered research analysts. But even if you just want to become a savvy and educated investors, this is a must-have. Hundreds of people have already joined the courses of NISM 10th A, 10th B, and NISM 15th, and they are on their way to earning as research analysts or investment advisors. See the link in the description and join if you want. Now let's look at the shareholding of one recent overpriced IPO, Paytm. See the increasing number of retail shareholders till March 2024 and then the drop in the current quarter. This is what we call distribution, or less charitably, bag holders, meaning people who ended up becoming the exit liquidity for larger sharks. So make sure that you are not that guy. So coming back to the point, let's take Paytm again. Before its IPO, its biggest shareholders were global funds like Ant Financial, SoftBank, and Elevation Capital. The IPO had a large offer for sale component, meaning that these funds were selling their stake. Once it listed, the number of retail shareholders exploded, and within months, the stock fell over 70% and the number of retail investors started dropping. That is what professionals call distribution. The smart money distributes shares to the less informed public at high prices. Once the dust settles, Those retail investors are left holding shares that no longer fit the glowing story that they were sold. In simple words, they became the exit liquidity, the last buyers in a chain of profit taking. Now it's harsh, but it is the truth. The same pattern is visible across multiple recent IPOs. When you look at shareholding patterns before and after listing, you will see institutional holding falling and retail holding rising. And that is your warning sign right there. Why does this keep happening? Because IPOs today are not sold on numbers, they're sold on stories. Every presentation, every ad campaign, every interview is crafted to make you feel something: excitement, pride, or FOMO. Be a part of India's growth story, they say. Invest in the next unicorn. But behind all that emotional marketing lies a very rational arithmetic, the arithmetic of exit. The company wants the best valuation, the banker wants the highest fee, and the early investor wants the maximum return. And you, the retail investors, are the liquidity they need to achieve all that. The only person who can protect your capital is you. Now, we are at an interesting moment in India's market evolution. More people than ever are investing, demat accounts are at a record high, and SIP inflows keep growing. Retail investors are now a real force in price discovery. But financial literacy has not caught up. That is why these overpriced IPOs succeed, because demand is high and discernment is low. The good news is that this also means opportunity. If you can build a real understanding, if you can separate value from noise, you will be miles ahead of the crowd. You will stop chasing hype and start identifying quality. And that is how real wealth is built, not through IPO pops, but through informed patience. So if you want to become an informed, intelligent investor, make sure you check out my courses on nismgem.com. The link is in the description. Remember, marketing can make you believe a lot of things that are not true. However, knowledge can help you see the truth. Subscribe and join the Telegram group.